Hey everybody, it's Bob with Trade Genius. I got my good friend Phil here. Retail's doing it again. Stay tuned. Phil will explain everything to you.
Trade Genius.
Phil, some things never change.
Some things never change, and Wall Street banks on that.
Show people this chart. It's amazing.
Sure. So if you guys look at this, this is basically where retail is allocating. You never want to be here in the market when retail is at these extremes. So we got 48% of retail allocated to equities. This is household aggregate financial asset allocation. So this is the equivalent to retail being all into these markets. Okay. So this is exactly where we were at the peak of the dot-com bubble, right? Everybody back then, the taxi cab drivers were all, investing in Cisco, and everybody was in on it, and everybody was making a lot of money actually until they weren't. And a lot of people, I had heard a lot of stories of people giving everything back, and they had built up a pretty decent sum. So I don't think much is different here, Bob. The readings are just so identical here. And, this week we've been showing a lot of metrics as to why the market's probably going to price in an economy that's rolling over next year. And, exactly where you would expect retail to be is right there at the top. But whenever retail gets to these levels, it doesn't even have to be 48%. When we had the great financial crisis, they were up in the low 40s. But it's basically what that means is there's just a lot more retail activity. And I think they've been trying to sucker in retail for a while now. Remember, they removed the commissions right on stocks and things like that, stock trading. And to me, I remember you and I were talking about that. They're just like, we're just really trying to sucker these guys in this 2-year window that we've had, but I think it's all set up now. So if retail's smart, they'll kind of say thank you into the last of the pump here and exit stage left. But you and I both know that's not what's going to happen.
No, and look, interesting about 2008, the reason why it didn't hit the highs there is because real estate was going absolutely crazy. So people had a choice. A lot of people were making a lot more money in real estate than they were in the stock market. This time they blew the real estate market up first. So there's no competition for the stock market. And they blew the bond market up too. So there's no competition for the stock market. But you can only go so high. Physics takes over and we're there. And so if you're smart, you'd be paring back, you'd be getting hedged. And a lot of people are probably hoping and praying they get into January so they can take a year to pay their taxes. But I think Mr. Market's ready for that. And I think they're going to blow people up right before that happens. So just be wary. You got to look at your own portfolios and determine what's best for you. The good news is if 2000 repeats, Phil, is that we'll get a rotation. Equity ownership may collapse because tech collapses, but we may get a rotation into commodities. So there'll be a place to make some money. And if that's wrong, then the bond market's going to be strong. So there's always a place to go. You just have to be open to whatever the market's going to give you. And I think those choices are on the table. And you can see it in the market this week. Oil gets hammered, bond market gets bid. Oil shoots up, bond market gets blown up. Market goes down, gold goes up. So you just have to kind of be open and watching. What we don't want to have is basically a general, collapse of everything. Then that's a total liquidation phase. And then really the only place you're safe is in cash. But I don't think that's going to happen, at least not yet. And we'll just have to let the market tell us where to put our dough. With that, Phil, that's all I have. Come trade with us, tradelikeagenius.com, and look forward to talking to you guys again soon.
Trade Genius.